related industries. And for the last about 6 or 7 years, since 2015, I've been working with UT Extension based here in Murray County and serving a 13 county area, including Williamson County. So I'm happy to be here, and I guess we'll start our presentation.
Yes, thank you. And if you have questions, something I forgot to mention, put them in the chat box. I'll be monitoring those and getting those to Les when they come through. So thank you.
Yeah, thank you. Yeah, I know on the itinerary it says basics of farming, I believe it is, or business basics. But tonight I kind of wanted to focus more on budgeting, production and financial budgeting, which I feel is really the basis of any good farm plan. Whether you're currently farming or looking to expand an operation through adding an additional enterprise, or kind of analyzing what you have. Let's see if we get this on here. I said I'm part of the managed program. Basically, this was started back in the 80s when we had a farm crisis, and we're looking for a way to help those farm families better understand or evaluate their individual situations and kind of improve those financial situations of quality life, helping them to make better financial and production decisions for their operation. Since that time, it has grown and kind of evolved just like agriculture has, moving a little bit away from these full-time farms, more toward the beginning farmer, value-added productions, and those looking to start into farming, whether it's 5 acres, 20, or a couple hundred acres. I'm one of 9 across the state. Currently, we do have an opening up in Montgomery County, up in the Great Green counties. However, if you're in one of those counties, it is being served either by myself or Tori Marshall, or Kevin Ferguson, or Alan Galloway. So there is a managed agent representing every county in the state. And if you need to get contact information, please let myself or Taylor know. We'll be happy to put you in touch with one of the managed agents throughout the state. But tonight, what I'm going to cover is enterprise budgets, kind of their purpose and use that you can instill within your operation. We'll illustrate how to do a budget, how to construct it, and use it within different enterprises. And we'll also look at some of the partial budgets that you can utilize, where you don't have to kind of go through and do a real detailed analysis, but just using it partially to make some of those decisions that for your operation. First, an enterprise, when we talk about a whole farm, we break it down by per enterprise, which would be, for instance, if you grew wheat or peas or calves, those are individual enterprises. And the reason why we want to break that down to is kind of understand better, the cost, the revenue of each of those entities, and see how they can be analyzed and compared with each other to help you make those decisions, whether you want to expand or contract an enterprise or add a new enterprise to your farm, and see how it affects the whole farm budget. Once you have that really detailed budget, the enterprise, they're like a building block of that whole farm entity. You can use those budgets to develop a cash flow projection, whether it's going to be on a monthly or yearly basis. And I'll tell you, having that information, if you're working with a lender, having a cash flow statement and a balance sheet going in is a great aid in getting the financing that you need. Also, for those who may be thinking about applying for a grant, whether it's a value-added grant or a grant through the state of Tennessee for maybe an enterprise, adding a new enterprise to the system. Again, these are really helpful in aiding you in achieving those grants and winning some of those awards. So an enterprise, it's an estimate of the cost and returns. Now, again, they're not going to be exact going in. Things change, especially yields. Prices will change some. However, prices actually, as you receive, may make it a little bit easier to work with. It's a distinct part of the farm or ranch that can be used to analyze separately. And we base it on a production unit, whether it's an input unit or the number of acres of land, individual animals, say a cow and a cow-calf operation, or a doe. Other ways we can break this down, not only by acre, but if you're having a farmer's market garden, it can be broke down in square feet or animal units or square footage, say in a broiler industry. These estimates are cost and returns that are based also on the complement of machinery that you may have, land, labor, technology that involves the whole farm, but we break those costs down in addition to this as well. Another great aspect or aid of an enterprise budget is used to determine that break-even price in yields. We always kind of say that it's really hard to determine a price that you're going to ask for what you raise or grow. Is that a good price, or is that price that you're going to plan on receiving for that? Is that a good price? Well, you don't know until you know your cost of production, your break even, so to speak. Without knowing that, it's difficult to market. It's difficult to market for a profit. When we look at especially commodity crops like corn or soybeans or cattle, you're able to kind of price things out, or especially on the crop side, where you can have a number of different marketing opportunities through the year, where you can market part of your crop. When is that good time to sell? Well, a lot of it's determined on that break even and when to implement that. You can use these enterprise budgets to itemize your receipts, what you have coming in from each enterprise. We also talked about keeping things separate as far as even on the livestock side. As far as on, say, a cow-calf operation, you want to itemize those receipts for, say, the call cows or breeding stock you sell or feeder calves. And also it gives you a good basis as far as when you're planning your inputs that you need for that crop or livestock, making sure you account for all those costs. And again, when you have those enterprise budgets or farm enterprise budgets, you can kind of evaluate the efficiency of each one. Which one is bringing in the most profit or best utilizing your resources. And it can be used to kind of break down whether to expand an enterprise or contract. Now, one thing that I'll say with that is, especially if you're raising, say, a farmer market garden or produce, and you start evaluating enterprises, even though one enterprise may not be as strong, possibly losing some money, doesn't mean you should necessarily eliminate it from your whole farm enterprise. Oftentimes, say if you're raising tomatoes and you're taking a little bit of a loss on it, it may be good to continue to raise that so you have it in that product mix. Also, having that extra crop that you're producing will help defray some of the fixed expenses that you have for machinery and et cetera. Also, like I mentioned before, it really supports that application for credit. If you're looking for an operating loan from year to year, having those numbers is a great help to showing your lenders that you'll be financially stable and be able to make those payments down the road. So each one is based on an accurate production of financial records. One thing to kind of remember is there's many extension and university budgets out there, and even some private budgets, but you want to use your own information and realize that each operation is different, their inputs and resources, and also their financial obligations that they do have. So we want to make sure that we're looking at each individual producer's costs, revenues, and also their goals that they have for long term. We want to factor other things in when we're putting together a budget. Of course, land, want to make sure that the land will support what you want to grow or raise on it. I know Dr. Lockwood has a saying that you should live where you farm, not farm where you live, meaning that your land will dictate what you are able to do with it. So if you have a piece of ground and you want to grow, say, blackberries or peaches on it, and the soil type, the slope, things like that are not feasible for it, it's time to probably look for another type of enterprise. The equipment, want to look at those resources that you do have and whether you can kind of cross-reference or use those for multi-enterprises to kind of lower down some of those fixed costs. One thing that I think is really overlooked is labor, especially if you're looking at some of these more intensive operations, whether it's going to be blueberries or blackberries, understanding how many hours a year that you have to devote to it to fully reap the benefits. For instance, if you look at a blackberry budget, it's in the range of around 250 labor hours per year per acre. If you're looking at strawberries, it could be 400 hours per acre. So there's some of these enterprises are very labor intensive, and you have to look at not only can you afford the labor, but can you find the labor to work with you on that? And also other resources would be the capital. What kind of are you putting your own equity into it, or are you going to be borrowing? Another thing that we kind of talk about from time to time is that a new enterprise, borrowed capital is pretty good. This way you're not tying everything up of your own equity. And if you have a setback, it's kind of difficult to kind of come back and try to get a loan on a setback. So, reaching out for outside capital in many cases is the right thing to do. On the crop production system side, we'd like to identify some of those resources that are available to you, especially crop rotations. Is one really important aspect of agriculture that kind of keep in mind. How do the different rotations work into your system, whether it's corn and soybeans or rotating winter wheat with soybeans. The timing of the operation is also very important. Like I mentioned, some of those value added crops, especially on the vegetable and fruit side, the planting, the care of them, the harvest, do they overlap? If so, are you going to have the labor to fulfill both those operations, or do you need to have a variety of crops that kind of time themselves out, where your harvest possibly, like say May or June for strawberries and maybe blackberries later in the season, then working it in with maybe your commodity crop rotation more in the fall. Other issues are storage of the products raised. Oftentimes that's one of those overlooked things, especially on the value added side. If you're doing berries or fruit, vegetables, do you have a place where you can kind of keep that produce cooled down before it goes to the farmer's market or to extend that time? These are costs that need to be factored in as well. And in processing and delivering. One thing I'll also really caution on is when we put these budgets together, and I've worked with people in the past, especially doing some of the value added, the marketing cost of it or advertising is oftentimes overlooked or way underestimated. It takes a lot of time and resources to do a complete market and advertising campaign for farm produce. Another tool that I like to use is called like a crop enterprise checklist. A few years ago, we did a sustainable business planning, and within that homework that we had a checklist on the crop side, and you can also there's also one on the livestock side where you kind of go through and make sure that you account for everything that's going to go into that system coming up in this year. So if you're doing crops, you want to look at the herbicide, fungicides, any type of pesticides that you're growing, the seed, the fertilizers, the different fertilizers that you'll add in, any of the other things that, customer service, if you're paying for crop scouting or freight companies, you want to, factor in fuel and repairs. So you want to make sure that you have a checklist that everything is counted for before you really start in putting the budget together. One miss on one item can really throw off the profitability of what you're doing. On the livestock side, it's much similar to the crop side, but you also have some other concerns as well? You're talking about herd health that you need, balancing the feed and forage nutritional levels, those rations that you have to have in place. Livestock can be really financially heavy at different times of the year. And say if you're doing dairy, you do have that steady paycheck coming in throughout the year. But if you're in a cow-calf operation, maybe only market a couple times a year. So you have to work closely with the budgets, putting those in place with the cash flow statements to analyze when bills are due and when revenue is coming in, and if you're going to meet those obligations. Speaking back with that cash flow statement, that's why it's critical to have, as far as if you're working with a lender and you see an opportunity where instead of, say, selling your cattle in July, you want to extend it to September for increased prices and chance for improved profitability. You can work with your lender in extending maybe an operating loan. Having those numbers in place is critical. So, the purpose of the enterprise budget is to estimate the projected cost and revenues. And for that single enterprise, again, it's assessing the feasibility of that potential enterprise, matching it up against, do you make money on corn or soybeans? What are the changes that you can make to an operation? For instance, if you want to change up what you're doing, say a new idea, currently there's a lot of call for people are looking for GMO corn. How does that compare to the conventional corn grown? Well, doing a budget and analysis, you can look at the two and compare. On the GMO side, typically it's less, it costs less to plant and take care of. However, the yields are going to be lower. The GMO corn, you'll have a higher price that you should receive per bushel, and you have to kind of compare that against what you have for a normal conventional corn crop. Do they match up? Does it make sense to do those type of things? The only way you're going to know is having those costs for each enterprise broke down. For instance, we want to use, a constant based unit. So crops, like I mentioned, 1 acre typically. On livestock, typically we're doing 1 head. On a cow-calf operation, that mama cow is 1 head, including the calf. Like later on, we'll kind of look at a budget from Kentucky on about some vegetable crops where they have it broke down by row length. Other ways you can do it is by square footage as well. But one thing that you want to do if you're doing crops, you want to make sure you have those units based against each other, using that same unit of measure. And the same thing with on the cow-calf side or cattle operations. You want to make sure you're using that same base unit. One thing with the budgeting, it's that building block of the whole farm. It's what makes your farm plans come together in what we talk about a whole farm plan. This way, when we have that together, with a managed program, we use some software called FinPack. We could put this information into it with a balance sheet, cash flow statement. We could put these budgets in, and then we'll be able to analyze any changes you want to make in your operation going down the road. For instance, if you were to buy a piece of equipment, say a tractor, we can kind of look at and see how that changes up on the cash flow. Or if you want to consolidate some loans and take up, or for a new line of credit, you can see how that kind of affects the whole operation in the cash flow. So, there's a lot of great tools that we have available for our clients, and we'll be happy to share those with you as well. And again, I mentioned before, like when you're looking at enterprise budgets, whether you're using one from University of Tennessee or Mississippi, one thing you want to do is use your own cost that you come up with. I've seen among cattle producers within the state or even in South Central Tennessee, what a difference one operation to another makes. And by having it broke down into your own numbers, you're going to know those numbers. You're going to know your production enterprise and what you're doing with that. And this is the best way to kind of determine what road to take going forward. like I mentioned, we use those existing budgets. They're very easy to kind of modify. I'd be glad to sit down with you if anyone has any questions about how to modify a budget to their situation and which ones would work best for you. But also, you really want to learn, some of those assumptions behind a sample budget as well. For instance, when we look at budgets, if we pull up, you do a Google search for blueberries, you'll see there's many out there, whether it's from Oregon State, Georgia, Mississippi. One thing I do really suggest is that when you are, especially whether it's livestock or vegetables or crops, is select a budget that's from an area where you live. You wouldn't want to really pull one from Oregon State or Washington if you want to raise blueberries in Tennessee. Their production practices and costs can be quite different. So pull one up from the region that you're in, especially for weather related. So whether it's going to be from North Carolina State or Kentucky, that's a good choice. Same thing on the livestock side. You don't want to pull one up from Montana or Colorado where they have range cattle. Those costs can be quite different. And again, their production methods can be quite different. We have a great one here in Tennessee as far as a cow-calf operation. And then again, whatever you choose, make sure that it's kind of mimics what you're doing as far as production side and practices. So some of the different parts of we look at, of course we have the input cost, revenue is minus cost is the return. We have our categories broke down, variable, sometimes called operating cost. Those are going to be the ones that kind of get used up within the course of a production. The fixed costs are going to be some of your overhead, also called ownership cost. And these are going to be costs that are going to have to be paid no matter what, whether you raise a product or livestock or not. This is going to be, say, taxes or insurance, interest at times. When we look at machinery costs, this in many cases becomes a little more difficult to kind of break down and split up. Because, who keeps track of every hour that you're on the tractor in a specific field or enterprise? It becomes a little more difficult, and we don't expect people to do that. There's other ways of kind of breaking those costs down, and we'll talk about those and as well. The opportunity cost, this is referring to owner labor. Farmers are notorious for not paying themselves until, say, at the end of the year, taking out whatever money may be left over as far as a profit angle. However, what we want to do is include your labor into an enterprise. For instance, if you have a cow-calf operation, kind of budget 8 to 10 hours a year per mama cow, and then you can put in your own, what you feel your labor cost is, what you should be paid, whether it's $15 or $20. And the reason why we do that is to make a true analysis of that enterprise. So if you weren't working with cattle or raising vegetables, your time could possibly be used elsewhere. Same thing with owner capital. If you're putting your own money or resources into an operation, you want to be kind of paid. It's a cost. So that money or investment maybe could go to another area, whether it's putting into an investment elsewhere and receiving a return. So in order to match that up to see whether it's truly being of value to have that enterprise budget or that enterprise, we want to make sure we're including your labor and also capital in that to see if it does make sense to go forward with it. Looking at some of those direct costs or variable costs, you have your seed, herbicide, insecticide on the crop side, also crop insurance. That's another cost, and some risk management strategies is also a cost, as well as fuel, repairs, operating interest, those indirect or fixed costs, which will be overhead. Again, that whether it's going to be insurance, taxes, that type of thing, and then machinery depreciation investment and land charge, whether it's going to be rent or a charge to land that's owned. Again, it's a projection. We can go back at the end of the year and do an analysis, kind of really break down all costs, so we know down to the penny what it cost us to produce a bushel of corn or to raise a feeder calf. But in those projection goals, probably one of the most difficult things is to predict is yields, either on the crops or say on the growth rate of cattle. We can get pretty close on the cost, but however, it becomes more difficult on the yield. So what I like to do is go back, say if we're projecting for 2022 and we're looking at a corn or soybean yield, we look at historical data and do an average over maybe 3 years to see what we have raised per acre per year, and use that data. Same thing with some of the costs if they're unknown. One thing about being consistent in developing budgets, that the more that you do over time, the more accurate they'll become. So looking at it a little bit further, when we look at some of those revenue sources, the revenue is kind of easy to estimate as far as price times yield, especially when you have a history, especially for commodity crops, corn, soybeans, livestock, especially cattle. We can kind of look at some of those future markets 3, 4, 6 months, or even a year down the road, and have a pretty good idea of where that price is going to be. On the input side, if you're ready to grow it, you should kind of know it, so to speak. But also, once you have your basis built as far as what kind of chemicals you plan to use, fertilizers, you can kind of call around to get prices. This year, it's been very difficult with, as many of you know, as far as with the rising fertilizer and chemical prices, doubling, in some cases tripling in price. And that's even if you can get some of the chemicals that come about. I mean, it can be done as far as getting a good estimate on cost, but it does take some work to kind of go through and put these numbers together. But again, this is, your livelihood, this is your time and effort. So again, anything that you can do up on the front end before you put a seed in the ground will definitely pay off. It said, there's the livestock budgets. There's a lot of different ones to use. Typically, it's 1 unit, 1 hog, 1 ewe, 1 cow calf operates. The time periods. Now, I don't say on a hog operation. If you have a sow, she could have a couple litters a year. Same thing with ewes and does. But we do want to put those in 1 year. Want to use, say, January, December 31st, and those costs will be adjusted into that time period. Machinery, facilities, equipment, fixed and variable costs, we want to, again, adjust those just like we do for crops as well. When we look at the livestock enterprise budgets, especially for those that raise crops, the way that I want to do it is, for instance, if you raise corn, you could sell it for $6 a bushel, but it only costs you $4. You need to credit your crop budget $6 as a revenue source. And if you're using it on the livestock side, that input needs to be $6 as well. You don't want to use $4 on your livestock side. You want to make sure that you're using that opportunity cost of what you sold it for against your livestock. Now, when you're putting together a Schedule F form and your taxes, it really doesn't make much of a difference how you price it. But again, this is the way to really analyze, what is making profits and what is really costing you money among each enterprise. The same thing with say manure. If you have a poultry buildings, for instance, or a dairy facility where you have that manure as fertilizer, I really suggest having it analyzed to determine the value of that fertilizer. So again, you can credit your livestock side with that value of fertilizer and cost it against the crops. Again, this is a way to determine the best use of your assets and within that full production system. As far as hauling, delivery, for instance, if you're hauling grain from one farm to another, say moving that feed from your grain business over to, say, the livestock buildings, you want to kind of split that cost up. The same thing with manure. If you're transporting it across the fields, the time, cost of that, you don't want to put it all on one enterprise, because it's kind of a partnership between the two. So kind of divide those costs out when putting an enterprise budget together. Here up on the screen, we have a livestock budget. Actually, it's a cow-calf budget from the University of Tennessee. And in our budgets, we always put an assumption with each one to kind of talk about what we're looking for or the inputs that are going into a budget. So here we have some cow data as a representative of this example. 50 cow herd with 2 bulls. We have a cow-calf, or I should say a calf crop rate of 90% with some death loss put into it. We call out a certain amount of cattle each year and need replacements. We look down here on the pasture side, the amount of fertilizer that we put down in the pasture for the cattle. Also, hay, if we're raising our own hay, we look at the inputs that we're going to have to that and the period of time that we will be feeding and the amount of hay that we'll be selling. Other things here will include our protocols for veterinary medicine, not only for the cows, but for the replacement heifers and bulls and calves, and also factor in a marketing cost or commission, insurance, and also some of that fixed expense with buildings and equipment are also included within these budgets. So we'll look at this one, for example, here when we look at a cow-calf budget. This is at the top here, it's going to be revenue. We break it down per cow and then also per herd. Now, these are a little bit older numbers. In fact, those prices that we're receiving right now are a little bit higher than that. But again, just for an example purpose, when we look at it, so when we look at per cow, every year you're going to sell some cows. So we break that down as a percentage and we assign to each cow in the herd. Same thing with the calves that are sold. As you see here, you can see that the amount received for the heifers is considerably less than steers. And that's because we're not selling as many heifers. As remember, we will keep back some of those heifers as replacements. But we look at that total revenue that cow is bringing in per year is $622. So as we develop these budgets, we look at what it costs for pasture production each year. Here we have about $120 in this example per acre. And kind of a rule of thumb, it takes about 2 acres per cow to maintain her per year. Now, again, back with those pasture production, we're including everything. We're including what it costs to bush hog that pasture, spray it, fertilize, and also establish it. Same thing with the hay production. We factor in all those costs of baling, cutting, wrapping. We've got that figured in, the cost that it is for the bull, supplemental feed, etc. And then labor, if we have it marked down here, again, this is your hours that you're devoting to that operation and the amount that you're paying yourself. So when we look at just those variable expenses, we can see that's about $600 in this example. Again, that's including your labor amount. We factor in interest, kind of an opportunity cost of carrying these costs as far as feed and pasture production. You see that's around about $18 a year, including that marketing. So when we kind of look at totaled up here, you can see within this example, we have everything included. It's about $638. So kind of a net loss here, about $16. We factor in some of these fixed expenses, so whether you're having your livestock facilities, purchased breeding stock, some of the overhead, which would be some buildings, equipment, etc. We can see it's about $341. Now, given we're factoring everything in this fixed expenses, In most cases, on a livestock farm or a cow-calf operation, you wouldn't have that high. But again, just looking at, we want to make sure that we're accounting for all the expenses. Another example, this one's from the Center for Crop Diversification from the University of Kentucky. It's a great site to go to if you're looking for different budgets for vegetable production, fruit nut productions. And one thing I like about their budgets here, they kind of break it down. In this case, it's by row feet or 700 feet of a row. And this is for pumpkins. I'm just kind of looking at, your revenue source here and also the variable cost that you have for each, within this system. One thing also that's really beneficial about a budget like this, as you look here, oftentimes on the vegetable or fruit side, your production cost, yes, it's considerable, but then you look at the harvesting, just look at harvesting and marketing, which is more actually than the production cost. So if you're looking at a year and maybe you have a weather event where the production just isn't there, or the prices are very low, you may consider not even harvesting or taking the time to harvest and market that product. Maybe it's cheaper or more beneficial just to leave it and maybe even apply for insurance reimbursement, maybe based on the cost that it is to the amount of time and effort you're having for harvesting and marketing. So it does give you those options to start looking at it and helping to analyze your situation. Other things that sometimes the overhead that we kind of talk about, which is like the machinery, buildings, and facilities. How do you determine what it costs to plow a field or the cost of a barn, or what portion that tractor repair should be allocated to a certain enterprise? One good, really helpful, useful tool is from the Mississippi State, and they have a budget calculator. And you can go on there and look at machine costs. They have it broke down, say, per acre, what it would cost to, say, bush hog a field or to bale a field. And they have it broke down by equipment cost and also by variable cost. So, the oil, the fuel that it takes to do that operation, the cost, the fixed cost of carrying that piece of equipment across that acre of ground. So it's a great tool to use when you're really planning budgets. One thing with machinery, it may be difficult, say if you have a record keeping system like Excel that you may be using or Quicken, to every time to allocate, say, fuel, oil, or repairs to each different enterprise. What I suggest that works really well is just allocate it all to overhead expense. And then at the end of the year, you could break it out by enterprise. So if your machinery costs, say, are $10,000 a year, and your cow-calf operation is 50% of your whole farm plan, then allocate $5,000 to your cow-calf operation. If your blueberry enterprise is 25%, then allocate 25% of that machinery cost or overhead to that enterprise, just to make it easier at the end instead of trying to divide everything out as you go through the year. Again, the machinery cost, it could be anywhere from 25 to 40% of an operation. Variable cost, like I mentioned before, fixed cost, depreciation. These are all kind of difficult to kind of keep up with through the year and allocating. So again, having that all kind of broke down and probably put into one category, overhead is probably the easiest way to do. But again, making sure that we account for each of those categories, taxes, insurance, those other related and unrelated repairs and labor costs. So we want to make sure that everything is accounted for. Other ways to kind of adjust for custom rates for machinery. You can go to Kansas State, has a great one, and so does University of Wisconsin. One thing to remember with custom rates, when you go to some of these different websites, it's going to be cheaper than what you actually can own that machinery for and do it yourself, just based on the fact that when they look at these custom rates, these are from operators that are doing many acres over a period of time. So, their cost structure is quite different, and they can do it for a lower cost in many cases than an individual can. So when you are allocating those expenses, you want to make sure that you're adjusting for your own cost and time as well. But it does give you a good base to start with. We talk about some prorated other costs. Earlier, we talked about hay and pasture, but we want to allocate those expenses. So for instance, if you're reestablishing a new pasture, it could cost, say, $120 up to $200 to, say, retill that soil, plant it, fertilize, spray. You don't want to take all that expense in 1 year. You want to allocate it over the life of that stand, typically 4 or 5 years. So in this case, if we look at the establishment cost, it's $120, and we want to base that on, say, a 4-year average before you would have to kind of reestablish or renovate that again. So that gives us a cost of about $30 per acre per year. So again, we want to bring those back into our yearly budgets, not just allocate it all to 1 year. Transportation, storage, marketing, these can be some really large costs, especially when you start looking at the cooling costs for if you're doing vegetables or flowers, getting those established as well. So that's kind of where you would break the storage costs. Would be another one where you would prorate it out or depreciate it out amongst the enterprises. And don't forget about the marketing part of building that budget. Like I mentioned, it could be quite substantial, 10, 15, 20% of the gross revenue can be going to marketing. Not factoring that in can really bring a lot of surprises at the end of the year when you find out how much it really costs to move those products through. Like I said, allocating that overhead expenses, talk a little bit more about, some of the workshop costs, whether it's going to be, tools or power going to buildings, legal fees, insurance, membership dues, some of the accounting costs, utilities. Again, just lumping those together. When you break them out, it's kind of easy to do when you're using your Schedule F tax form, just kind of looking at those supplies in the other category and using those as you come to the end of the year. So we kind of look at a profit and loss statement or Schedule F on a farm business. We kind of look down here at number 32, line 32 on the expense side. We could, put in dues, fees, DHIA, some miscellaneous supplies, taxes. So we can kind of pull out some of those numbers to use in the overhead expenses. It's probably a little bit easier to do with the income statement. That gives you a better allocation of cost. We can, build budgets and whole farm plans off the Schedule F. They just won't be probably quite as accurate to begin with. I definitely really encourage using 3-year averages for costs, not only for budgeting, but also for tax purpose to kind of avoid some of those adjustments that you have. The main idea here is to allocate a percent of each of those costs to each enterprise, but allocate all the costs. By having a good set of records and budgets, this is kind of where we kind of develop our break-even yield and prices. So if we know in this case what it costs per acre to produce corn, in this case $600 is what you'll have invested. We kind of forecasting these kind of older numbers, but still say $4 per bushel that you would receive. You know that you have to hit that 150 bushel per acre. You can kind of go back over history of your operation to see kind of where you fall into place. For instance, that 3-year averaging to kind of see where you fall in. And then and on the flip side, looking at some of that break-even pricing. If you know, typically it's going to be $600 per acre divided by that 150 bushel. You have to hit that $4. And as mentioned earlier, that knowing your break-even price allows you to market your product more effectively going forward. Knowing when it's time to take that profit, not knowing. So it's difficult to have that marketing plan in place. Is $6 good to receive, $3 good? Without knowing your cost of production, it's difficult to kind of make those decisions. And you'd be surprised with how many farms that I've been on that are either full-time or part-time farms for generations, and they really don't know their cost of production here. Next, we'll kind of look at some parcel budgeting. This could be used, say, if you want to do, say, a parcel change in your operation and see kind of how it plays out. For instance, a lot of cow-calf producers do stockpiling in the fall, which means that they kind of set aside a certain amount of acres of pasture and let that kind of grow up in the fall without the cattle on it. And then more toward the winter months of maybe November, December, they turn the cattle out. This is a way to kind of reduce their purchase and growing of hay and to determine, if it'd be a benefit for them to do that. So just looking at an outline of a parcel budget, you have a category, a topic of added revenue, reduced expenses, the credit. We also look at the added expenses that a parcel budget or changes to the operation may have, and then total debt, and then the difference within that change. So when we look at the stockpiling example here for 50 cow herd, we'll be setting aside 25 acres. So we look, is there any added revenue? Well, no, we'll be selling the same amount of calves per year, so there's no change in place, but doesn't reduce the expenses. So we look at if we could put those cattle on 25 acres for 30 days, and at the usage rate, we look here that we'll save 17 tons of hay at $75 a ton. So we kind of see that we reduce our expenses by $1,284. Now there'll be some expenses in doing that, and one of the first expense here is going to be adding nitrogen to that pasture. Again, this is an old example since it only shows 50 cents per pound. Currently, it's probably about 95 cents a pound. But nonetheless, here, if we look at 25 acres at a cost of $30, you see that cost here is about $750. There was no reduced revenue since you'll be, again, selling the same amount of cattle. So we did reduce that debt. Our debt here, our cost $750, but we see that net change of income of a plus $500. So by just doing a partial budget, this kind of plays out the benefit of adding that stockpiling rotation to our system. Now, if we look at it again and we see that this cost has really went up, then it may not be in our best interest of doing that. But when we kind of look at what it costs overall with increased chemicals and fertilizer costs this year, this number is going to be gone up just the same here. So overall, just off the cuff here, I would have to say that either way that this will be a benefit any operation. So in summary, the enterprise budgets are the building blocks for the whole farm plan. They can allow that producer to evaluate the efficiency of different farm enterprises. One thing about enterprises, especially when if you're thinking about adding some, they can definitely play a big role in the overall success of a whole farm operation by allowing you to spread out some of those overhead costs or make better use of your equipment and labor. Having that tractor, if you're only using it 100 hours, but adding a new enterprise for an additional 50 hours could definitely reduce those fixed costs throughout your operation. Also, allocating those overhead, Schedule F, into that whole farm plan. So, in closing, enterprise budgets play a big role in the success of any farm operation. I really strongly encourage you, no matter what your operation is, to implement those in. I'd be happy to meet with you to develop them, not only an enterprise budget, but a whole farm plan, or talk more about how you can do that for your specific operation. This is my contact information. If you have any questions, please email me. I'll be glad to reach back to you and be in contact, kind of go from there. So I'm not sure what kind of questions that we had here, Taylor.
We haven't had any questions come in. I
Okay.
want to put that back out there. Does anybody have any questions for Les? You have just amazed them with just too much information they can't even process.
Well, it's not a very exciting topic. We'll put it that way.
But it's an important topic. So
it is, yes.
any questions, anybody? You can unmute yourselves or put it in the chat box. And they've already asked if we could have your slides, that I could send them in a PDF.
Sure.
So they can go back to the information. That would be great. Oh, we had someone ask, where can we find organic regenerative forecasts?
I'll be honest with you, I have no idea. I mean, that's something I can look up and go through and see what I can find out. I'm trying to think I'm not sure if Cornell University would have anything. I know it's a fairly kind of a new topic.
Yeah, I'm not sure. We can look into that.
Yeah.
We can look into that and see if we can get you some information.
If you have something specific on the organic side, if it's, fruit and vegetables or blueberries, blackberries, that type of thing, please send that information to me and I'll see what I can find out here for you.
Wonderful, thank you. Yeah, she said blueberries would be great.
Okay.
And someone asked, when considering new crops, is there a good source for projected yields?
Now, if you're new to that piece of ground, typically, if you go to your FSA office, Farm Service Agency, they'll have a record of some of those yields in the past, especially on corn and soybean side. Farmers will come in and they give them that data. And the reason why they give them that data is that if there's a crop failure or disaster, they can receive some payments on that. So really each acre of land should have that data, or I should say each section of farm, through the FSA office, Farm Service Agency. Other than that, there's a number of different data through Extension. We can kind of look back and see what the average yield was, throughout Tennessee over the years, that type of thing. But FSA is a really good source for the commodity side. As far as, say, vegetables or blueberries, blackberries, it varies so much within each operation. A lot of that has to do with production practices and care of each, and then the weather. The weather is a big issue as well.
Definitely. I know we got some new fact sheets that came out, I think, about blueberry production.
Yes.
Not too long ago.
Yes.
Yeah. I'm not sure what, Adam, I'm not sure what y'all are looking at growing, but we always have new fact sheets coming out. So you can send me some specific stuff and we can see if we can get you some better answers. But yeah, FSA would be, yeah.
Dr. Lockwood and Dr. Margarita put out some new publications on budgeting for blueberries and blackberries just recently. So
yeah.
Those up as well.
Any other questions? Got a great info, Les. That's what they're saying in the chat box. All right. Any other questions, anybody? Okay. I'm not seeing any more questions. Anything else you want them to know? They've got your contact information.
Yeah, I'll be glad to put individuals who are not in Williamson County, maybe from the outside my area, in contact with another managed agent.
Wonderful.
If they want to work with them as well. So there's no cost to the program to use.
Okay, wonderful. Wonderful. That'll be great. Thank you so much, Les.
Thank
And
you.
I'll get the slides from him so we can send those to you. We really appreciate you, Les, taking time out of your night to speak with us. It has been great, wonderful information that is very vital. So thank you. All right. And so you guys, next week, remember, we will be on site. I sent you the address for that. Look in your email. I'll also send it again in our recap email. And I'll send the info from this meeting, and I'll get this posted online so you can go back and watch through it again if you need to. And other than that, if no one has any questions or anything else, we will call it a night tonight, and we will see y'all all next week. Thanks again, Les. It was wonderful.
Thank you, Tyler.
All right, y'all have a good night.